Hey guys, Trisha Turner here. This is Walk Away Wealthy. It's Tuesday, 12 o'clock Central. I got my good friends Jared and Scott on with me today, and we got some technical difficulties, so we're coming in a little bit late. This is the first time ever, y'all, that people have been trying to enter the studio. So somehow the link got out. I don't know how I did it or they did it. I think they did it.
No, you did it. You did it.
The link is out. So if y'all are trying to enter the studio, we're not going to let y'all in because it's just for me and them today. So thanks everybody for joining us. Walk Away Wealthy is a podcast we bring every week to bring you positive messages, education to help you grow your business and improve your life. Today, we are bringing you a super hot topic because interest rates are like the news everywhere, right? 7.25%, 8 is talking about maybe 9, maybe 10. We don't know. We know they're not 2 anymore. We know they're not 3 anymore, 4 or 5. And so they have a product that we're going to talk about because even before interest rates started creeping up, they introduced this product to us, and it's a way to build wealth, which Walk Away Wealthy, right? It's the name of our show. And like how you can pay your mortgage off in less than half the time, save like so much money. Because you guys, when you're paying on your home mortgage, on a 30-year mortgage, you may not pay that thing off or even start hitting that principal to like 20 years. In the meantime, you're paying in all that interest. The bank's using your money to buy other assets and invest, and not on your behalf. So Jared and Scott are like specialists in this, though they don't like to call themselves that. And they're hilarious. They're not very tech savvy. So at any time during this program, they could disappear. They could do something weird. Just ride it out. Hi, you guys.
Hi, how are you? Hey, yeah, we are special, if you want to say that. So,
you are special.
but,
y'all are super special.
Yeah.
Hey,
are we on?
Yes. Y'all are on.
So, yeah, the all-in-one loan is something we basically probably found out.
Hey, hold on a second. First of all, let's tell everybody who you're with, like where y'all are in the world, and how long y'all been doing it.
All right. Well, I'm Jared. I've been doing this 20 years now. So I'm the seasoned veteran, I guess. But we're with CMG Financial, CMG Home Loans, and it's just something that
that is the best you can do.
What do you want to say? I mean, I've been doing this a very long time, longer than you. So
yes, I'm Scott Middleton. I've been doing this for 10 years, and we're ready to rock and roll. We're CMG Financial. Let's go, Jared.
Okay, let's go. So what else you want to know?
And so what do y'all do? What's your specialty? And number one, let's talk about interest rates for a minute. So as of today, Tuesday, whatever it is, it's election day, by the way, y'all haven't voted. I haven't voted. I'm going to vote. You voted?
I got my sticker on. Look.
Oh, you do? I didn't even see that.
Yeah.
Well, we're going to vote later. You got one on too? Okay. Well, we're going to do that later. Yeah. But interest rates are like the super hot topic. So as of today, what are you guys seeing for interest rates? Talk a little bit about that.
So I'd say the average 30-year fixed rate today is sitting around 7.25%.
Okay.
And depending on your credit score, the loan type, the down payment, all the variables, you can see anywhere from 7% to 8.5%. There's crazy rates out there. We don't ever sell rate, but it is a factor, and it is, people who were qualified 6 months ago might not be qualified today for the house they want to buy. Sure. It's just. Rates are something we tell people it's temporary. You're not married to the rate. Rates are going to change. I mean, there's predictions like what you said, 8, 9, 10%. There's also projections of high 4s, low 5s in a matter of months, So my belief and philosophy on that is no one knows. I follow these market experts all the time, and they're wrong as much as they're right. Today could be a big day for what happens in the market. You can see a big rally. You might not, but elections can definitely swing mortgage rates. So, but rates are just something, like I said, they're temporary. Anyone that buys a home today is going to refinance their home tomorrow when rates go down. So, why not? Let's get them in the home, start building the equity while prices are still stable, or maybe even gone down a little bit or softened, and, get the tax advantages, build your equity, refinance later. So it's really, Scott and I are really good at kind of counseling people on that, just kind of educating them and explaining, it doesn't matter. You'll probably refinance this home twice if rates go down to the 3s. Yeah. Refinance at 5.5, you'll refinance at 4. And, so there'll be people that refinance at least probably 2 times if the market falls like it was previously. So rate really just, other than getting someone qualified where it could affect them from what their buying power, rate shouldn't really affect people from buying, because buying is still always better than renting. I ask people, what's your rate on your rental? 2,000%. I mean, you get no tax advantages. You're building no equity. You're basically burning your money every month. So really the rate obstacle, although it is an obstacle because everyone's so accustomed to 3s and 4s and, and now they think 6s and 7s are high, which they are, but historically they're still in line with the averages over the last 50 years.
So before we go into your product that we're going to showcase for everybody today for them to see, like how to really change their lives, let's talk a little bit about ARMs too. An ARM is an adjustable rate mortgage, you guys. So there's this like stigma about ARMs, like don't do an ARM. Oh my gosh, your interest rate's going to go crazy. Talk to everybody about ARMs if you could for a minute, please.
ARMs got a bad reputation. So one of the ARMs that we do is a 10-year ARM, which literally means your rate is locked in for 10 years before it adjusts. Now, the chances of rates dropping in the next decade are fairly high. Like Jared says, everybody has a different opinion, but everything is cyclical, and that's a strong product as far as I'm concerned.
Well, today, for example, you could probably lock in the 30-year fixed rates at 7.25-ish. You could probably lock in an ARM today at 5.75 to 6.25. You do a $400,000 loan, that's probably $300, $400, $500 a month. Do that over 84 months or 60 months, and the savings is substantial. And
huge.
And I tell people, I did ARMs in the early 2000s. I did the subprime ARMs, where they lock you in at 2 years.
Oh yeah, I remember those.
And at a 3-year prepayment penalty, so you were, they couldn't afford homes at the 5.5 starting rate.
Yep.
But when it adjusted to 9, they really couldn't afford. The bad part was, after it adjusted at the 2-year, they had a prepayment penalty. They couldn't do anything for 3 years or 4 years, and those were subprime ARMs, and they were tied to very risky indexes.
Yep.
Versus A-paper ARMs back then were great, and today, 10 years ago, they're great. Today, they're great. They're tied to safe indexes, like they were the LIBOR. Now it's the CMT index, the Constant Security Treasury Index, and those are historically perform well below the 30-year fix. So, for someone today who tells me they're only going to be in a home for 3, 4, 5 years, or we know the market's going to improve and they're going to refinance, why the hell not save yourself $300, $400 a month every month and play the waiting game on it? And that really is something. They're not for everyone. For an ARM, you probably got to have 700 plus credit, be putting down 10% or more.
Okay.
But for those that do, it's a phenomenal savings. And once you get them past that stigma that ARMs are bad, usually we'll have a first-time home buyer, second buyer, and they're like, no, my parents said don't ever do an ARM. I'm like, tell your parents to shut up.
Right.
They know what I'm talking about.
But those are the parents that when they bought a house, their interest rate was 9% when they bought it.
The house was $80,000. So today it's $380,000. And it's so you can't compare the 70s and 80s when their parents bought homes to today. You just can't do it. The cost of living before inflation was 100% higher than it was then, and it's substantially higher today. So, it's all about saving money. So if they were to talk to a financial advisor, 9 out of 10 and not 10 out of 10 would advise them, take that ARM. Let's invest that $200 extra a month, or let's do something valuable with it. But the point is they can save money while rates are high and then refinance when rates drop.
And your safe haven to me is if you're in a 10-year ARM and let's say it, quote unquote, it does hit the fan, rates don't fall in a decade. Well, when you get to that 10-year mark, you can just simply refinance into a 15-year fixed rate if you want. You're still cutting 5 years off your 30-year mortgage.
Or you can sell your house. Most people are only in their house 7 to 9 years at the longest.
It just doesn't happen. I have yet to meet someone that did a 30-year fixed and stayed in it for 30 years and paid the loan off. It doesn't happen.
The rarity.
Yes.
So on y'all's ARM, is there a prepayment penalty?
You won't find that on any. The only prepayment ARMs you're going to find, like your non-QM, your non-qualified mortgages, you hear like your bank statement loans, your I-10 loans, your no-doc loans, all those out-of-the-box loans that aren't Fannie, Freddie, your conventional, your FHA, your outside-the-box loans. And we need to get some that doesn't have tax returns, whatever. We got to get them qualified, and we got to go non-QM. Those will have, not all of them do, but some might have a prepayment penalty on them. They can still refinance. It's just they're going to have a penalty associated with that. So you won't find them on any A-paper products. So nothing conventional. No one has any prepayment penalty on anything I've seen.
And that's because the bank, if you think about it, it's the bank risk. So we do a 20% down, what we call a no doc loan, where we basically drop someone's credit. If it's an investment property, we're not pulling bank statements. Like it literally is a no doc. You got credit, you got 20% down, let's do the loan. Well, they put those prepayment penalties sometimes on those loans because those are high risk loans. Yeah. And say somebody doesn't claim anything on their taxes, and then the following year they do, and they refinance out of it. Well, the bank has just loaned all that money on a high risk loan and then turn around and not made a penny on the deal.
Yep.
So you'll see those sometimes.
Yeah.
So for you real estate agents out there paying attention, number one, don't be afraid of the ARM. So they just told you about one of their products. Well, now two, the 10-year ARM. So interest rates, he just told you like high 5s, low 6s on an interest rate. So if you're representing a buyer and they want a lower rate than that, good luck, but you can buy the rate down too. So you can get the sellers to help out. It's a way for you to continue to sell homes, even in a market where there's a little bit higher interest rate. So you guys got to train your brain to rethink of these other products. It's not all 30-year conventional. In fact, you should get away from those because you're just throwing money away. So let's go into this other product that we're going to talk about. Let's talk about the name of the product, kind of walk us through like the history of this product, because I know it's been around for years, but it's fairly new to Texas, I believe. And then we're going to have you share your screen so you can show everybody through it.
Okay. So the all-in-one loan is called the all-in-one loan, and I will explain why it's called the all-in-one. But it's been in the United States. CMG's got it's a proprietary product. It's exclusive to them. It's been in existence for 18 years across the country, and it's new to Texas. It's been here about 3 years. It just came on the homesteaded properties in March or April, so it's on primary residences. It's brand new, but it's been here in Texas for a few years now. I think it's a product that intimidates borrowers and intimidates loan officers trying to educate people and explain it. So once you educate yourself on it, you really get it and you see the value in it. But so in 18 years across the country, we like to tell people it's never had a single default. Think about that. On any loan you've ever done, a car loan or any credit card, people go in default on everything. They miss payments. There's never been a single 30-day late on this product. And it's because when you qualify for it, it virtually makes it impossible for you to go late or miss payments or do those things. And we'll get into that in a bit. But the history on it, and we like to tell people, like we don't want to get too deep in all that because it'll bore you to death. But mortgages in the United States have been done the exact same way since 1938. Since the Great Depression, they came off trying to stimulate the economy. They went from 10-year notes, 15-year notes to 30-year notes, stretched out loans to help people qualify for homes, get the economy going back in. We're blinking. I don't know if that's happened on your end. So banks win in that environment, because if you know anything about installment loans, not revolving debt, but like your mortgages, your cars, everything's front end loaded with the interest. So it's 22 and a half years on a mortgage for more than half of your payment goes to principal. For the first 5 to 10 years, it's almost all interest. So you make $2,000 payment and you've knocked down your principal $72. The rest is going to interest. And that's the way it's staggered, and it gets a little bit less deeper into the loan. But so banks love that, because what do they do with that? They take the interest and they leverage all their other businesses with it, and they run into everything. Yep. And so, and that's the way loans are done here in the United States. You go anywhere else in the world, you go to Canada, the UK, France, Japan, Australia. I think this was originated in Australia, but you go most everywhere else in the world, and they do these mortgages. They're called offset mortgages, and they're principal paid first loans. So the interest is paid last. So it's the opposite effect of how we do loans here in the United States. Yeah. So you think about that, your principal first paid. So everything you pay into this account goes to your mortgage, and we'll explain how the loan works. But so everything goes to your principal, and you're paying your interest last. So that, right there alone is you're attacking your principal so much faster, which is how you take it from a 30-year note down to 5, 6, 7, 10 years. You're paying it off in a third of the time or less, or half the time or less. And you're substantially eliminating that interest. So you compare, we'll do a similar in a minute on a $500,000 loan. And we'll show you, typically you're saving a couple $100,000 in interest, real money that you're saving. So we talk about the whole point of this, like in this conversation, is in a rising rate environment today, what can be an alternative for them? This is a great alternative for them. This loan, where I really confuse people, or kind of like I have to get through to them, is I tell them, look, the rate doesn't matter on this product. I'll show you how, but it doesn't matter. And they're like, what do you mean? I'm like, we'll get into it. But I'm like, a traditional loan where you're comparing a 30-year loan to a 30-year loan through two different banks or whatever, and your payment's set on that mortgage, that interest rate, and you're paying that same payment for the life of the loan. Yep. The rate matters then, because you're trying to get the lowest possible payment because you're fixed at that.
Yeah.
This loan, again, the interest is paid last. The rate, it's an interest only payment paid last, and you'll see how it works. But to me, this loan it takes an offset mortgage, which is a principal paid first loan, and banking, and it combines them into one. So you're all in one. So this loan combines your bank account. So whatever is deposited in this bank, it sweeps to that mortgage. It knocks it down dollar for dollar, which is a big benefit.
Yes.
The beauty of it is the borrower has access to every penny that goes into that mortgage.
I think that's the most important thing. So it keeps you liquid. I ask people all the time, because you get borrowers, well, I'm going to pay $200 more a month on my mortgage. And that's great. Let's pay your debt down. But what if you have an oh crap moment and you need $5,000? You have to do a cash out. And we live in the state of Texas where cash outs are unlike any other cash outs in the United States. It's a whole different animal. And, this way you're paying down your principal, but if you do need the money, you can go get it. And you think about in the state of Texas, where we've just had skyrocketing, house values go up. And if these people were liquid, how much money they would be sitting on. They're sitting on it now. They just can't access it. Yeah. So you have a group of thousands and thousands of people that are literally sitting on over $100,000 in their homes, and their options are either A, to cash out, and they're going to take a higher rate than what they're in, or B, sell the house, and that's the only way to access the money. Those are your two options. There's no other way. This loan, that's why we've all done it ourselves and put it on our own houses, because if you have a job loss in 3 years and you're sitting on $100,000, guess what? It don't matter. We've literally done calls with people that have lived in their homes for 8 years and never made a payment because they had so much equity in it. And so, one of the cases that we called, because we did a lot of background on this loan before we started going out in the market, and it was a lady, and basically her husband passed away, and she stayed in the house because they had enough equity, and it just kept making the interest only payments. There was no emergency. She didn't have to turn her house or have her world completely flipped upside down. She dictated when she was going to move, when she was going to have some closure with the situation. To me personally, that's what's the most important thing.
It is.
Yeah, being huge. I mean, it just is, because again, like what Scott said, getting your money out of your home in the state of Texas is difficult. And usually what happens is when someone needs the money, a life event might have happened, and they might not qualify for the loan. And their only option is to sell their home. And, but like you said, you literally can live off your credit line in your home. And in a sense, it's got kind of like reverse mortgage features to it, where the equity, you're using the equity. You're just not doing a reverse mortgage loan where you pay all the points and the fees and all that. So
I think you should start the simulation.
Yeah, let's do this. Let's have Jared share the screen, you guys. So this is a simulator. He's going to be able to actually show y'all their product. So Jared's screen is up.
Oh, sorry. I mean, that's wrong.
Hey, hold on a second.
Sorry, Scott.
Oh my God. Did you really just do that? Are you kidding me?
Total slip of the fingers, man. It's total accident. I don't know how that
I'm going to kill you.
Okay. So,
everyone got a kick out of that.
Oh my goodness.
Scott, you'll be a celebrity.
Okay. We're not going to let him drive ever again, Turner.
Okay. Yeah. Okay. So this website is available for everyone. And what we do is when we explain like how the product works, just kind of give them some background like we just did, and we're going to send them, hey, like, you have time, let's go do a simulator together. The website's just www.allinOneLoan.com. So anyone can go there, and I'll kind of walk you through this so you can see how it works. So if you ever want to walk through it yourself, it's pretty easy. And there's all kinds of information on this site. You can watch videos, you can read testimonials, you can do all that. There's a ton of information. You can register for webinars, which we do with our clients. So as we educate them and we tell them about it, we're like, look, you go do some research, you play around with this, go do a webinar. They're 30, 40 minutes. They have them twice a week, and they're very educational. They'll walk them through the whole thing. And typically what we've seen is when people do this, they all come back and want to do the loan. Once they get it, they understand it, they're over their fears or whatever, they come back and they all pretty much want to do it. Some people get it right away. The broker owner I did a presentation for last week, he just called me an hour ago. He said, I'm sending you a client. He's like, they're from the UK. He's like, this is how they do loans with them. I'm like, yeah. So he's like, they got it. They want to do the loan. So some people get it.
Hey, Jared, real quick, let's give everybody that website again in case they want to kind of walk through it. What is it?
It's www.allin1 spelled out loan.com. So allinOneloan.com.
Okay. Jared, you're showing your age with the www. Nobody says that anymore.
Okay,
were you born in the 60s?
Oh, okay, just allinOneloan.com.
Yeah, allinOneloan.com. You don't have to go. It's www. I mean, what is going on?
I'm not good with technology, and I was born in the mid '70s, so I kind of am there. So
allinOneloan.com, right?
Yes.
So that's where you guys need to go if y'all want to see this simulator, because Jared's going to walk through it right now, and you can go through there and figure it out for yourself if you can. $200,000 loan, $800,000 loan, you name it. Jared, let's do a $500,000 one.
Yeah, we'll start with a $500,000 one. We can run through maybe 2 or 3 of them quickly, because what we want to do is show like how it works on a primary, secondary, mainly like investments. Your investors absolutely love this product, and I bet you 70% of the calls we get on this are people wanting to do investing on it. Even though I just did on my own 2 months ago, I want to do on my primary. I want to buy a second home on it, and I want to do an investment home. Currently, you can have up to 3 all-in-one loans out at one time. They're working on getting up to 5.
Wow.
And they're also working on a product that potentially you can wrap in like 5 properties into one all-in-one loan. So they're trying to advance this product further, which I believe they will. But let's just start with the simulation. So,
real quick though, can I just ask a question? Is it only where is this loan? Is it only a Texas loan, or because we got people watching from all over?
All across the country, every state. I don't know about New York, but typically everything's everywhere but New York.
Okay.
But everywhere else it's available.
Okay. All right. Let's see.
We've been doing some of these in Florida lately. I don't like every state's different as far as it like catches fire. It like goes in waves, if that makes sense. Like because most of the time when people, this is what the benefit of doing this. If you're a real estate agent, which this is a proven fact, we thought it was quote unquote a sell. When you do one of these with your clients, these are the loans that everybody talks about in the neighborhood. So you're going to get a referral. Once we close one of these for you, you're getting 3 more deals because these people all run with the same people, so to speak, and they're going to tell their friends. And so as a referral basis, it's huge for agents.
All right, let's jump in. Show us, Jared, what you got.
Okay. So typically, like there's a calculate savings tab at the top of the screen, or you can scroll down to the bottom, but we want to get to that calculate savings, and we're just going to do a new simulation. So we can compare to existing loans and show them, get more in depth with it. So we're just going to right now compare to a new loan. Like if I was comparing to an existing loan, this would be like if I'm refinancing them, they might be at 4% today, and I can still show them 6% on this loan is going to way outperform it. That's why I tell them rate doesn't matter. I get into showing them, and I'll show you here in a second. But so let's compare it to a new loan. Let's just do a primary residence on homestead right now.
Yep.
Just so I don't want to get into
something people can relate to.
Yeah. So let's just do a primary residence right now. I click non-homestead. We can do homestead on it too, but there's some different features on the buttons. The loans act the same whether it's a primary, secondary, investment, homestead, non-homestead. The features of the loan all work the same. It's how they interact. What the borrower has to do on a homestead is a little bit different. I'll explain that in a minute. And then, like Scott said, Texas has the strongest equity laws, the most protective equity laws, which is why it took so long to get this product to Texas. Everywhere else had it because of the constitutional equity laws when you wanted to pull equity and all the, the features you had to get passed. So it took them a while to get with attorneys to figure out how to get this into Texas, which they did. So we'll just compare to new, and we're going to start with the home values. This is your sales price. Just say $500,000. I might have done 5 million, which I did.
Well, slightly aggressive, Jared.
Okay.
Yeah.
Okay. And so this product will tell you if you do something wrong, like just say I put in loan balance of 425, it's going to be red. Well, it's supposed to be red. It's 80%, Scott.
So we're doing a sales price of 500,000.
Yes.
Yeah. So we're going to compare it to a 30-year fix today. Again, what did I tell you? The 30-year fix rate is 7.25.
Yeah.
Today we can use that. We can use any rate and we can plug it in. Again, I can show you. I'll go back in a minute and plug it at a much lower rate. So there's some features in here. You could do extra monthly payments. Like people always ask, well, if I just paid extra a month, then I could do the same thing. I'm like, well, no, you couldn't, because you're still paying interest first. And if you're talking about changing your spending habits, then we can apply those extra payments here, and you're going to pay the home off even faster.
Yeah.
You don't want them to change anything and give me any other weird scenario. Like, let's just show them what their current spending habits, their current bills, what they make a month. So for here, we're just entering the loan details, kind of comparing to what we're going to loan. So we're not doing any extra payments. These deposits. So what we need to know is, what do they make a month? What are you depositing a month into your checking savings on average? So we can use some generic numbers here. Let's just say they make $15,000 a month. We're buying a $500,000 home here. They got to probably make some decent money.
Yeah.
So we're going to have a repeating deposit of $7,500. It's semi-monthly. If they get paid once a month, you could put monthly.
Okay.
You have options of monthly, quarterly, however they get paid. Some people might be self-employed and they just take, so this one-time deposit will be something like that's a feature that, like, say they had $100,000 in their checking account, or they're going to sell a home and they're going to take a bunch of money. That would be where they put in a one-time deposit. Let's just say they're going to clear $25,000 extra. They had $25,000, because what they're going to do is, once they see how this loan is working, again, this is a bank account they're going to set you up with. So like me, I did mine. I'm with North Point Bank. That's who services this loan. CMG owns this loan. North Point Bank services. So they set me up with a 24/7 all-access banking account. I mean, they send me I'm not going to show you my card number, but they send me an all-in-one debit card. So just like my other bank account, so I use it every day. And they give you a checkbook. You can do wire transfers, whatever. It's a bank account. It's an FDIC insured bank account, just like any other bank. But
you have to do this one-time deposit. What if that was zero?
You can use it. You can put it at zero.
Yeah, you don't have to do it. I'm just saying
zero.
Okay, yeah. So that would be like, because if they have money somewhere and they see how this loan's working,
they're going to throw their money.
This loan encourages you to put it into the mortgage, because remember, you have access to it. So if it's in a savings account, you're better served to put in here, because, and I'll show you why. Because as you're paying down this loan, your balance resets, your payment resets every day. So the lower your loan goes down, the lower your payment is. So your interest only payment is based off your balance. And we'll show you how that works here in a second. So the more you put in your mortgage, the less you're going to pay a month. So if they have extra money laying around somewhere, they're going to sell something, they're probably going to want to put it into this mortgage. So that's what that feature's for. But we can use it as zero now.
Yeah.
Again, repeating deposits. You can do one-time deposits, like they're going to get a bonus or whatever at some point. You can come in. So you can get kind of unique and aggressive with this depending on their situation. And they know it. Like Scott, the very first loan we did was with a physicist. He's an engineer, retired engineer, physicist, who put on his expenses, he had it down to the penny. And here's screen 2. This is where
he literally had it down to where his rent, his electricity, water. I mean, he had it down. He brought us in a spreadsheet.
Oh my gosh.
Unbelievable. It was like, this guy's detailed. It was great.
It was $7,803.03. It was down to the penny, I swear.
That is insane.
And that's where you go to the spending tab, the next tab.
Right.
And this is where you can enter it as a monthly deposits, or you can itemize it and they put in their expenses, So we're just going to do it as a percentage left over. And that's where, so they're putting in $15,000 a month.
Okay.
We can, if we know the taxes and insurance, we can plug that number in. This just generically calculates a number in there. But if we know what their taxes are, they're probably going to be more now in this house. It shows you what their traditional payment would be, like at that 7.25. But so this is where I ask them, what are you spending a month on average? You're depositing 15. What are you spending? And then they'll tell me, say, $4,500, or we'll figure out what a percentage left over is. So I could say, they're depositing 15, they're spending 7,800, they got 3,700 left over. Okay. So again, this loan, people ask me what's the catch on this loan. Once they see they love it, I'm like, well, it's not for everyone. Not everyone's going to qualify. Not everyone has a 700 plus credit, 20% down, DTI under 45. It's a manually underwritten loan that we follow like Feeney conventional guidelines to.
Okay.
And not everyone has the ability to save money, especially today.
Right.
So for these people, if they're not saving more than they're spending, then it probably doesn't work. But what loan does today? If you're not saving some money, you can't afford the payment. So, but let's just use 25% left over. And
which is very, that's being very cautious. Most of these borrowers are 40%, they have way more. They're saving way more than.
Yeah.
And even the ones that are saving 10% works, and I'll show you that too. But let's just say, so we're just using those parameters, okay? And then we calculate the results. And here's where it starts to open people's eyes a little bit more.
Right. Y'all see that?
Yeah, your traditional over here shows you what you buy a $500,000 home today at 7.25. If you were in it for the life of the loan, you're basically spending $1 million on this home. $582,000 goes to your interest. Again, you come back over to the all-in-one, you're spending $125,000 on interest. You're paying it off in 23 less years, and you're saving about $450,000 of real money in interest.
And you got a $400,000 credit line.
Correct.
Yeah.
So if the loan's paid off, if it's paid down to half, this is what you got. And there's a rate and assumptions tab, and I like to show people this is where you have three options you can choose. A 1 month adjustable, which is what I did. It adjusts every single month of the market, and I'll show you why I'm not afraid of it. A 3-year fixed and adjustable, which is going to give you your best starting rate, and a 5-year fixed and adjustable. So, but we can run
fixed for 3 years or fixed for 5, right?
Yes. Okay. And I think on the investment, you have the 1 and 3 year option.
Yes.
You don't have.
And I haven't personally locked one with the 3 year. Literally everybody that I've done so far is choosing 1 month adjustable.
Yeah,
okay.
We did 3.
And why is that?
It's because once you see where the market is at right now, it's probably at its high point. So this follows the CMT, the constant maturity index. It's at the high point it's been for the last 20 years right now.
Yeah.
So as rates fall, that falls. So every month if you're playing the market right now, which I think you're at your high point on rates, I'm willing to take the gamble that even if it goes higher, it's not going to go too much higher.
Yeah. But
we know it's going to come tumbling back down. I want to tumble down with it. I don't want to be locked in at 6.5, 2.5 years from now when rates are at 4.
Yeah.
And again,
riding it.
We got to get past what the rate is, because the rate is only the interest only piece paid last.
Okay.
It's not as important as a traditional loan where your payment's fixed off that.
Yeah, because they're literally like paying principal.
Correct. Principal goes first, interest paid last. And I'm about to show you. So over here on the you can choose. I can put the rate trend to remain at the initial rate, which is what is showing at 8.3% today, interest only, or I can choose the max rate it could possibly go to if it were going to the worst case. And I could go back to results. Now it takes it from 6.8 to 7.9. So even if this thing went to the max worst case scenario in this simulation on with the income and stuff we used, it's still only adding a year and a half. If it went to 12% interest, which it's never done. So you can see that. Let me just expand this graph. This is the CMT index over the last 25 years.
Okay.
And if this purple line is the 30-year fixed average, and you can see where we're at.
Yeah.
For the last 25 years right now.
Crazy.
Yeah, and you can see below the CMT index, the blue line, it's performed below the 30-year for the last 25 years. Yeah. So to me, I'm not afraid of this index that this loan is tied to at all.
No, for sure.
Right. So really, the rate to me, you got to get past, and we're going to show them the pay down summary. Let me go to this. Return the rate, return the results. So here's where I usually reel people in. After we get to this point, we show them the savings. One second.
The savings should be enough. It's like, holy crap, you not see that? You want to pay your house off in 7 years instead of 30. It's no freaking brainer.
Right. I mean, if I save no money a month, I'm still saving 3 months off my mortgage, which again, this is where you get to where it doesn't work. You got to be saving some money left over. You probably got to get to that 15 to 20% a lot of times. But see 20. So that still gets you. This is probably a realistic one for a lot of people because these expenses being higher right now. But what I usually tell people is once I said, we're not going to assume you change any spending habits, but once you get into a loan like this and you see your principal being greatly reduced, it's probably going to change some of your spending habits. You starting to see that light at the end of the tunnel much faster.
Yeah.
You probably get a little bit more aggressive with things, and you probably take this 10 back down to 7 or 6 because it doesn't take much to knock 2 or 3 years off this loan. Yeah. So let's look at this. We show you the rate and assumption tab. This pay down summary tab, though, is where I really like to show people. So you can go here. It shows you your minimum monthly payment on the traditional on the right, what it would be. So again, this minimum payment is starting at the highest. This $2,300 is still $400 a month lower, basically.
Yeah.
That's starting at the $400,000 loan. Each month, this is going to go down as your balance goes down.
Sure.
So that's why I like to show people, and it shows you your break even, your average APR, all that substantial less. Again, your average APR is going to be much higher, 7.25% over here at your rate. The average APR on the all-in-one is less than 4%. Okay. So again, I still have the worst possible case rate in here. I still have it the max.
Okay.
So those numbers I showed you at 10 years is probably closer to 8 or 9 if we have it follow the average. But this pay down table,
money.
Yeah. But here's the screen I love to show people. Here's the pay down thing. You can see the all-in-one loan on the left, the traditional on the right. I mean, I usually take them to like after year one. You can see 12 months into this deal, you've knocked $36,000 off your mortgage. So versus $3,000 or $4,000 less than on a traditional.
That's just 12 months in.
Yeah, you're paying $2,800 a month, but you've knocked $3,800 off your mortgage.
That
tells you where's your payment going? It's going to all the interest. It's going to the bank.
Yeah.
Let's get 2 years in. You've knocked $67,000 versus only $8,000. I mean, but like the 3 and 4 year mark is really where because most people are in the home like we established for 30 years, but people are for 5, 6, 7. So let's look at those numbers. So 5 years into this mortgage, I mean, you've knocked $157,000 off versus 22. I mean, now it's becoming real. 5 years goes by in a blink of an eye. You can see the damage you can do. The beauty of this, you have access to 100% of that $157,000. You want to go buy your investment property and pay cash for it? Yeah. You want to pay a loan? You want to go on a vacation? You want to do whatever the hell you want? It's your money. You don't need to ask
you could move up and buy a bigger home and use all that because you have more money that you could use now,
Well, that's what we're seeing. These people we're getting, some of our agents are getting listings off of this loan because they're going to take their equity out of their current home and they want to liquefy it. And so once they understand that the rate doesn't going to come into play, they're like all in. They're like, no, let's list and let's buy because I don't want to just do this loan on my current home. I want to go buy something bigger and better, or maybe just the opposite. I want something less, whatever the case might be. But they love that they can see the loan principal going down. And that's what our underwriter said, Scott, you running all these simulations on the worst case scenarios. These rates aren't going to be here for 20 years. These people are going to start saving more. She's like, you can take an hourly wage worker, and when they start seeing their principal fall, they owe $200,000 and they get paid $2,000 on Friday, and now they owe $198,000. Guess what? It's almost like addicting to them. They'll start driving that principal down because they can see it. It's not like a car payment where you're just writing it every month, They're like, dude, they can see it the next day on their statement.
Again, you take it year 7, you're $200,000 knocked off. I mean, you can keep going down the simulator, and a lot of times you get the end of year 7 and showing them paid off. And again, they have access to all the money, which is the benefit. But the way the payment's made, so we talked about no one's ever been late. They set this up like at closing. There's like a 1% that goes into this, so they can't miss their first payment.
Okay.
Any deposits go in their account, they're already ahead of the game. They've never had any lates. So, but the way the payment is derived is whatever. Like again, you deposit money into the account on the 1st and 15th. It resets. You go from 400 to 3. So I tell people when I'm breaking it down, I'm like, look, here's how it works. You start at a $400,000 loan. You deposit $15,000 that month. Now you owe $385 after month 1. You got bills to pay, so you're going to pay $5,000 out of that. Now you owe $390. You've knocked $10,000 off your mortgage in 1 month, and you still have access to that 10 that's available.
It's crazy.
You take that down 2 months, same thing. Now you owe $380 and you have $20,000 available to you just after 2 months. And that's the gist of it. Now your balance after month 2, you owe $380. So that it calculates interest daily, simple interest daily off your balance. So if you deposit every day, it's going to reset every day. If you deposit throughout the month, it's going to reset at those days. And so if your rate was 6.28%, you're going to be at 380 times 6.28%. It's going to calculate a daily interest of, say, $76. And each day of the month, it's going to figure out what that day was. So if it adds up 30 days at $70 average, and you pay $2,100 the following month in arrears, just the interest piece.
Yep.
So you're not making a principal. This doesn't have escrows in this. So the borrower is responsible for their taxes and interest. At the end of the year, I'm going to pull money out of my account and just pay my taxes, So that's the gist of really how it works. It's just combining a banking account with your mortgage, and they interact with one another. And, again, it's something that the beauty of this is it's not, we ask people, because some people cannot get past, the only thing that we struggle with is getting some people past the rate obstacle. And I'm like, that example, what do you think is a better option? A 30-year fix at 3.5% or a 15-year fix at 7%, say a $300,000 loan? And most people I'll take the 3.5. I'm like, well, you just paid $78,000 more on that loan.
Yes, that's so crazy.
Because you're paying it out over a longer time.
One thing that we are seeing a lot of traction pick up with this too, Tricia, is these people that have all these Airbnbs.
Okay.
Because they can take that Airbnb, let's say they rent it over the weekend, and they're taking that money and putting it against the loan immediately. One, they're not having to worry about making a payment when it's rented, when it's not. And two,
smart,
especially down in Galveston, we just did one where the lady, during the summer, she makes $15,000 a month off her house.
Sure.
And during the winter, it slows way down. Well, she's leveraging that money right away in the summer and paying her principal down. And then in the winter, when it slows and she has, quote unquote, the interest only payment, and it takes it out of her credit line, she's still, the other day when we looked at it, she was going to pay this whole entire house off in 4.5 years.
Crazy.
She just bought July, and we refinanced her in August when this came out. She was actually one of the first loans. So she's already almost planning next summer, planning, what to do. And she's like, this is just easier for me because I'm literally just taking this money. When I get paid off the Airbnb, I'm pushing it over to the all-in-one loan. I just don't have to mess with it ever.
No. And you're like you said, you have access to your money. It's this is a no-brainer. Hey, and that took less than 5 minutes to walk through that simulator.
Well, this real quick, I'm just going to fly through this like an investment. What you said, this is where we really people who want to invest or buy a coastal property or a house on the lake or the river or whatever, so like I was telling you, if you enter the parameters in here and it's red, you don't have something right. Investment property is not 20% down, it's 25. So I'd have $400,000 loan, I'd have to plug in 25% down and it's going to allow it. So in investment rate today, investment rates are probably at 8.5%, charging you 2, 3, 4 points. It's ridiculous. No one wants to hold that paper today.
Yep.
So I mean, you literally could probably put in 8.5% today on that. We'll do the same type of thing, except for this is a property that, for your investors that are going to Airbnb. Say I bought a beach house today and I want to rent it out. They're probably taking in, let's just say, well, we can do the same thing. We can do $15,000 a month is what they take in.
Okay.
The difference is here is they're not going to have bills coming out of this. They're just using their rental to pay for this property. So let's say they got some expenses, repairs. They got to pay property managers and whatever else. Yeah, let's just say that's giving me too much. Because they got taxes and insurance coming out. So let's just say they do that. I mean, this is where you could literally pay a home off in 3 years. If you had a high Airbnb property, where you're taking in a large sum, you rent out a beach house in Galveston, like he just said, she's taking in a ton of money, renting out half the year. You could really pay a home off. You don't spend a dime of your money. You're taking in just the Airbnb. you could do this on just a normal single family residence up the road where you're going to take in 2,000 and you're not going to pay it off in 2.8 years. It might be 7, 8, 9. But again, you're using someone else's money to pay off homes. And then as your equity grows, you take that and you go buy your next land or your property or whatever. And this is how people are really growing their real estate empires. Like Scott will tell the story. People in California coming here they're not all multimillionaires, but they all have a lot of equity in their homes, and they use this product across the country.
So we had tracked this one time, and I think it was like 27%. I want to say it's a crazy number, so don't quote me on it. But these people in California, they've been doing this loan for 17 years. So we had this influx of all these California buyers, and quote unquote, they were cash buyers. They weren't cash buyers. They had huge lines of credit. So they were just writing a check at the closing table. Like it was over 20%. One of the underwriters was telling me that the California buyers are using this loan to come to Texas to buy property because the loan amounts in California are huge, enormous. And so you have people running around with $1 million bankroll, and they don't care if the house is $400,000, they're offering $450. They're going to win the bidding war. You know what I mean? Because they're just writing a check.
And it happened again and again and again.
They don't have to talk to anybody. It's literally their money.
But think about that here. Like, we're not California, but we got a lot of equity we built in the last few years. And people can use their primary homes today, refinance like I did, to create massive credit lines to go buy investment properties. And that's what this isn't just a purchase product. I mean, your current clients, your past clients, all are sitting on equity. Now's the time to be gobbling up some of these properties. You're going to see foreclosures come about and people have to get out of loans. So I think there's going to be opportunities for investors to kind of scoop up some stuff here, and this is a loan that allows them to do it.
So anyone that's like looking at the screen, if that what's on the screen right now doesn't scream like that's crazy, 30 years or less.
You look at the interest savings, and so, and again, that's your extreme example, but people are buying. I mean, I was looking at coastal property 4 weeks ago, and people are gobbling up land and deals and everything else. I mean, so it's like, those are properties that are going to rent out. I mean, this could be a real scenario. This might be a little aggressive, but you could probably see 4, 5, 6 years with taking in Airbnb money. I've run the numbers because I'm trying to buy one. So, you look at what you're renting property for out there every month, and you can literally use that, leverage that money, and not spend a dime of your money once you get into the initial investment of the home. But
that was really good, Jared.
Oh yeah, thank you.
You did a good job.
Appreciate you. So if y'all just like recapping all of that, if you weren't paying attention to the very beginning, he just walked anyone through like a $500,000 sales price of a home and what the difference is in your payment, how much interest you're going to pay or not pay for the life of the loan, how much you're going to save, how fast you can pay it off. Like, this is a no-brainer, and you have access to it. It's like it's a bank account.
Yes, it's an actual debit card. And it works because Jared used it in the casino the other day.
It's actually a true story.
And it's not only primary residence, but it's also for investment properties. And like Jared said, you can have 3 going at the same time.
And I think 2 or 3 is probably good because now this scenario is like you're using the rent money to do it. But like if you're a second home and primary, you're kind of reducing the effectiveness of it. Because you want your deposits going into one, you start leveraging them, splitting them out. But it still works. They're still paying it off faster. It depends on how much money they make and what kind of debt they have.
This is all not just a Texas product either, y'all. It's pretty much nationwide. They can help y'all with anything. These guys, and it's their own product. So it's proprietary to them and their company that they're with. So don't think you can go call your friend over at Chase Bank and be like, hey, I want to get this all-in-one program. Not happening, or Bank of America or any of these other lenders. They're just not going to do it. And this is a way, because the banks, number one, most of them don't want homeowners to have access to that money. They don't want people to create wealth within their family because the bank wants to use that money and go do things.
Right.
Yes. That's the biggest deal that the first conversation we had when the underwriter literally told me, she's like, I am my own bank officially. I will never borrow for a car. I will never, if I want something, I'm going to go buy it.
Yep.
And it was like, okay, I get it.
Yeah, we like to tell you, you'll become the bank of Tricia. You become the bank of Scott. You're in control of your money. People like to hear that.
So there's like no stipulations as to what you can withdraw your money for, right?
No.
No one's going, you can't do that.
So like I told you, there's some differences. Like the homestead, we didn't go through that. The buttons just look a little bit different.
Okay.
But it's all the same. But you for a Texas homestead property, the minimum you could withdraw is $4,000. So if I needed $2,000 to pay bill, I'd have to pull $4,000 out, put it into the checking account, and then push $2,000 back to my mortgage. See, there's a a few extra. It doesn't automatically sweep. Like if this is a non-homestead property, whatever you deposit automatically sweeps that night to your mortgage, and you have access to it. On a homestead, whatever I deposit, I have to manually push. I got to log into my bank or on my iPhone or whatever, and I just push a button and transfer it in. Okay. So, but really, that's the main difference. And one more thing, like qualifying for this loan, even though there's some stricter requirements as far as credit, down payment, different things compared to a normal loan, there's also easier qualification as far as like we've got some people approved that are completely retired. We can use asset depletion, basically annuitize their retirement. A lot of these people have a lot of money in retirement. And you take $1 million and we can annuitize that over 120 months. I mean, that's like an 8,300. I know I've done this like 8,300, 8,333.
Yeah,
that would be an income stream of 8,300 a month. So we can get people qualified with literally no income taxes, no pay stubs, no W-2s, or people might have both. They might have a salary, but they're short to meet these requirements, but they got $300,000 in their 401k. We can annuitize that. We don't have to pull from it. We can create an income stream off it. So we can get more people qualified.
They're very aggressive with the income piece of this.
It's insane. It blows my mind. I mean, and especially in the world that we live in now, where a lot of people are looking for like opportunities and ways to make money, like or side hustles or open a little business or something. Here you go. Boom,
Right.
This is crazy.
And so like you can see the screen, I just did homestead. Instead of like deposits in, it says repeating transfer, instead of, expenses, it has repeat. Your advance is your money you're pulling out, so
same thing.
It's the same thing. It's just worded different, but all in all, they function the same way. And the way this loan, again, it's a 30-year loan, and it's after year 10, it's interest basically for the first 10 years, you have access to 100% of the credit line. Starting the following month after year 10 through the last 20 years of the loan, it reduces by 1% basically. So when you get to the end of the 30 years, your loan's paid off. You don't have any balance left. You don't owe anything. So your credit line will start to reduce after year 10. But if they've gained $200,000 or $300,000 in equity, they can refinance it into a new one and start it over.
Yeah.
So it really,
it's a no-brainer.
Yes.
Yeah. And you guys, in the real estate world, like, don't try to explain this. Number one, like, we've had Jared and Scott come here to our office. They've shown our agents how to do it. They've came here and shown us by ourselves, like, here, this is how this works. I had to understand it. So don't try to figure it out. You just need to call them and have them do a simulator with you, or get on their website and do it yourself. Try it yourself, because it speaks volume.
And there's YouTube video. You can go to YouTube, type in all-in-one loan. Dave Herbst is our product developer on this. He's been since the beginning. He's done it. He'll jump on the phone with our client. He knows the ins and outs and can explain things, because there are some people that will talk over our head for sure, and they're smarter than we'll ever be. And sometimes we need to reach out to Dave or Aaron and say, hey, can we jump on the phone with them? Yeah. And 100% they'll do it. When you want to do a big presentation, they'll fly in and do a presentation. I mean, they're like, so we have support on this if we need it, but again, we try to do what we just did today. We'll condense it down. We'll kind of put them in charge to go do some research, go do the YouTube videos, do the simulators, get on. And some people are like, no, I get it. I love it. And some people are skeptical and they got to do more. It's just because this is a product that seems too good to be true. But again,
that's what we hear all the time. Like, what's the catch? What's the catch? And like, there is no catch. We have done this multiple times now.
You guys are awesome. Hey, so we can wrap this up and get back to work from their lunch break. Where can they find you guys for info about this? What's the best way for them to find you?
Our cell phone, my cell phone's on there. Scott, we can send information. You can blast out our information too, Tricia. I don't know if you have a, but definitely our cell phones are always the best place to get us. We have support. So like Scott and I are a team. You send a loan to Scott, you're sending it to me. You send a loan to me, you're sending it to Scott. We have our team set up with our production assistants, which are, again, you call, we're not available. You call Carlos or you call Helen. One of us four should be available at all times. Or we'll get back to you as soon as we can. But yeah, we
give them your phone number, Jerry.
It's on there.
It's on the screen. Hey, what about a website for y'all?
Say that again. I'm sorry.
What about your website?
I don't know. Hell, it's on my email.
You don't even know your website.
It's on my email.
Kidding
what
me?
is what's your? I have no idea. It's a CMG.
Oh, here's my website. www. I mean.
I'm going to remove.
Are we done?
All right, it's off the screen now. You guys are awesome. Thank you so much for doing this. Y'all, we love them. We do business with them. They are one of our preferred lenders. For one, they have great energy. If you don't want to work with people that have good energy, I don't know what to tell you, because we do. We love it. They are constantly cutting up with each other, which makes it fun. But at the end of the day, they're like changing lives because they're saving people freaking hundreds of thousands of dollars. That's their goal, right?
Yes.
Yeah.
Thank you, Tricia.
Yeah, heck yeah. One more time before we close, where can they find that loan? Give us the simulator site.
AllinOneLoan.com. Just spell it out.
AllinOneLoan.com.
One is spelled out.
And Scott Middleton, since he didn't put his name up there too. And you can find them on Facebook. They're hilarious on Facebook too.
Oh no. God. Where is Jared?
Where is Jared? We don't have one of those pictures, right?
Yeah.
Next time we will have that picture.
Yes, we will. It'll be his screenshot for sure.
Oh yeah.
Yeah. Y'all have a great day.
All right,
thank you so much.
Thank you very much.
Bye y'all.
Bye-bye.